It's funny. We spend just this inordinate amount of mental energy obsessing over price
No,
tags.
constantly.
Right. Like we see the price of eggs go up and we grumble, gas drops maybe 10 cents, and we feel like we won the lottery. We track housing prices like it's a spectator sport.
Yeah, it's the user interface of the economy. It's the
Yep.
part we actually touch every single day.
Exactly. But reading through the research for today's deep dive, it really struck me that we're kind of just staring at the scoreboard without looking at who's actually refereeing the game.
Hmm.
Because there is this massive invisible force operating in the background that effectively dictates all of those price tags. It decides whether that morning coffee is just a casual purchase or, a luxury. It decides if you're buying a house or if you're snuck renting for another 5 years.
And it's not just some abstract force like gravity. It's a very specific, adjustable mechanism.
Right. So today we are unpacking our source material on what's called the key rate or the refinancing rate. But the sources don't just call it a boring economic rate. They use this metaphor that I actually found really helpful, even if it is a bit romantic.
The conductor.
Yes, the conductor of value, or the conductor of prices.
It is a really strong image. I mean, if you view the economy as this giant kind of cacophonous orchestra, you've got businesses on strings, consumers banging the drums, banks on the brass. It's inherently chaotic. Everyone is just playing their own tune.
Right.
The conductor concept suggests that without someone setting a unified tempo, the whole thing just devolves into noise.
And the key rate is the baton.
It's the tempo itself, yeah. The central bank wields the baton, sure, but the key rate is the actual beat that everyone, whether they know it or not, has to play to. It sets the price of money.
The price of money. That phrase right there is exactly where we need to start. Because for a lot of people, even those who follow finance pretty closely, it sounds a bit abstract.
Yeah, it does.
Like, money is the thing I use to pay for goods. It feels incredibly counterintuitive that money itself has a price tag attached to it.
But it absolutely does. And understanding that price is really the difference between being constantly confused by the economy and actually knowing how to navigate it.
So our mission today is to tear that whole concept apart. We're going to look at the wholesale warehouse model that our source uses, trace the domino effect that happens when that tempo changes because it is a massive chain reaction, and ultimately answer the big question for you. In this current tempo, is cash just trash? Or is it the ultimate luxury good?
Let's start right with the definitions.
Yeah.
The source material opens with this idea of the wholesale warehouse.
I really like this analogy because it strips away all the high finance mystique. It positions the central bank not as some scary government regulator, but just as a supplier, a massive wholesale warehouse for cash.
Right. Think of it like a Costco for capital. But here's the catch. You and I, the listeners, we don't have a membership card to this Costco.
We can't walk into the central bank and ask for a mortgage.
Exactly. We have to shop at the retail stores.
Which are the commercial banks. The apps on our phones, the physical branches on the corner. That's where our avatar for today, Annie, goes to get a loan.
Yes. Now, consider the business model of those retail stores. They need inventory, which is cash, to lend to you for your mortgage, your car, your credit card. Where do they get that inventory?
They borrow it from the wholesale warehouse, from the central bank.
And just like any business anywhere, they have to pay for that inventory. The key rate is literally that wholesale price tag. It's the percentage interest rate the central bank charges those commercial banks to borrow money.
And this is where the mechanism gets super interesting. The source makes a really crucial point here that we often forget. Commercial banks are businesses. They are not charities.
Right.
They operate on a margin. So if the central bank sets the wholesale rate at, say, 5%, the commercial bank cannot lend it to me at 5%. They have overhead, they have staff to pay, and most importantly, they have risk.
That is the key word right there, risk. The key rate acts as the floor for the whole system. It is the risk-free baseline. If the bank buys money at 5%, they might lend it to a super stable, massive corporation at 7%. But for you or me, maybe 9%. For an unsecured credit card.
20% or more.
Exactly. So when the conductor raises that wholesale rate, he's raising the floor for the entire economy.
Precisely. If the floor rises, the ceiling has to rise too. The source material is very clear on this transmission mechanism. If the cost of raw materials, the wholesale money, goes up for the bank, the price on the retail shelves has to go up. The loans offered to regular people get more expensive. There is just no way around it.
It effectively reprices the entire world.
Which brings us to the second part of our outline, the domino effect. Because
Go
this
for it.
doesn't just happen in a vacuum. The source introduces us to these avatars, Sean and Annie, to illustrate how this chain reaction plays out in reality.
And I appreciate that the text uses them. Macroeconomics can feel so dry until you actually see it hit a household budget. Sean and Annie essentially represent aggregate demand.
So let's walk through the dominoes. Domino 1, central bank sees things getting a little too heated, so they raise the rate. The conductor tightens the screws.
Right. Domino 200 and sill, the wholesale warehouse becomes expensive. Commercial banks immediately see their borrowing costs spike.
Domino 3, the pass-through. Commercial banks raise interest rates on loans for individuals and businesses to avoid operating at a loss. They raise rates for Sean and Annie. And this is where the lag comes in, right?
Yeah, it's not instant.
The source touches on this. It takes a minute to feel it.
It does, and that's what makes it kind of dangerous. Sean and Annie might not feel it immediately if they have, say, a fixed-rate mortgage. But the exact moment they go to apply for a new car loan or try to refinance or carry a balance on a credit card smack,
The wall hits them.
the wall hits them hard.
And that triggers Domino for the behavioral shift. The source describes this as a simple calculation, like, the loan is too expensive, so I won't buy the car. But it's almost more psychological than that, isn't it?
It is entirely psychological. People just take out fewer loans and spend less money across the board.
So Sean and Annie pull back. They cancel that summer vacation. They decide to drive the old sedan for another 2 years instead of upgrading.
Exactly. Discretionary spending just dries up.
Which topples Domino 5, the businesses. The car dealership sells fewer cars because people are spending less. The contractor gets fewer calls for kitchen renovations.
And finally, Domino 6, the macroeconomic conclusion. The entire economy slows down. GDP growth cools off. It's like the conductor forced the whole orchestra to drop from this frantic, loud volume to a very quiet, slow hum.
But this leads to a really obvious objection. If you're listening to this, you're probably thinking, wait, slowing down the economy, making businesses sell less, that sounds terrible. Why would the conductor ever want to do that?
It's the classic paradox of central banking. Sometimes you literally have to hurt the economy to save it.
And this gets us to section 3 of our deep dive, the why, the fight against inflation.
Right. To understand this, you have to understand what happens when the tempo is too fast for too long. Imagine a scenario where money is virtually free, rates are sitting at zero.
Everyone borrows, businesses expand wildly. Sean and Annie buy 2 cars instead of 1.
Exactly. But the actual supply of cars and houses and labor, those things are limited. So when everyone has cheap cash and is chasing the exact same goods, what happens?
Prices skyrocket. You get inflation.
And inflation is a nasty, nasty beast because it erodes trust. If Sean and Annie start to think prices will be 10% higher next year, they panic buy right now. They say, I need to buy that washing machine today because next month it'll be unaffordable.
That psychology actually creates the very inflation they're afraid of. It's a self-fulfilling prophecy.
So the central bank steps in and raises the key rate to break that psychology. They need to make money expensive to cool things down.
They're trying to snap Sean and Annie out of that fever. And the source material highlights a two-pronged effect here that I think is really elegant. It's not just about punishment, it's about changing incentives.
Yes. The first prong is the obvious one, expensive loans. The source uses the new iPhone example.
It's a great example. Classic consumer dilemma. You want the new phone, it costs $1,000. If you put that on a credit card when rates are low, maybe it costs you $1,050 over time. Totally doable.
But when the key rate is high, that credit card APR might be 25%. Suddenly that $1,000 phone effectively costs you $1,500 by the time you actually pay it off.
And you look at that math and say, yeah, no thanks, I'll stick with my old phone. That destroys demand. That's the first prong. But the second prong is the one that I think savvy listeners really need to pay attention to.
Profitable deposits.
Exactly. This is the flip side of the coin. When rates are high, bank deposits suddenly offer really high interest.
Right. Because when the key rate is high, commercial banks are desperate for liquidity. They want your cash so they don't have to borrow from the expensive central bank. So what do?
They bribe you. They offer 5, maybe 6% interest on savings accounts and certificates of deposit.
And that changes the entire landscape of how you handle your money. Think about it. If you can get a guaranteed return just by letting your money sit safely in a bank, why would you spend that money on a depreciating asset like a phone?
Instead of spending, you are highly motivated to just put your money in the bank.
Exactly. Saving becomes much more attractive than spending. You take your money out of the economy, literally out of circulation, and park it. and that drains the fuel right out of the inflation engine.
Less money in circulation, falling demand, and a slowdown in price growth. The conductor is essentially trying to find that perfect balance between inflation and growth.
Though history shows us they rarely get it perfectly right. It's a very blunt instrument.
Well, let's talk about what it feels like when that blunt instrument hits you personally. Because Section 4 of our source material moves right from macroeconomics into your personal wallet. It details 3 specific areas of impact.
This is where theory meets reality.
The first impact is the big one, mortgages. The sources are very clear that mortgages are directly, deeply dependent on this rate.
It's the most sensitive dial on the whole dashboard. The text notes that even a 1% difference in the key rate can radically alter your financial life.
People usually just look at the monthly payment, but the source emphasizes the total cost over time. Let's say you're getting a 30-year mortgage. A 1% hike doesn't just mean a few extra bucks a month. Over those years, it can literally result in hundreds of thousands of dollars in overpayments.
Hundreds of thousands. It's staggering when you look at an amortization schedule.
It's the difference between buying a house for yourself and buying a second house just for the bank.
And there's also the lock-in effect, right? If you have a 3% mortgage from a few years ago and the current rate is 7%, you are never moving. The housing market just freezes.
Then there's the second impact business. The source uses the coffee shop example to explain this.
I love this example because it shows how the rate affects everyday dreams. Imagine you want to open a small coffee shop. You need a loan to buy the espresso machine, sign the lease, do the renovations. If the key rate is low, the bank lends to you cheaply. Your business plan just needs to be moderately successful to pay that back.
But if the conductor has raised the tempo, if the key rate is high,
Then the loan is incredibly expensive. Suddenly, your coffee shop needs to be an absolute gold mine just to service the debt. You run the numbers, realize the whole business plan is unprofitable, and you don't open the shop.
and because you don't open the shop, you don't hire the barista. You don't pay the local bakery for pastries. The economic activity just vanishes.
Exactly. That's how a high key rate cools down business expansion.
Which brings us to the third impact, which the source explicitly calls the only plus side of a high rate: savings.
We touched on this, but it really is the silver lining. For savers, high rates mean the money sitting in their accounts actually works for them much faster.
Right. When rates are low, cash in a savings account is practically losing value to inflation. But when the conductor raises the rate, the saver is king. You get a real return on your capital.
It shifts the power dynamic from the borrower to the saver.
So putting this all together, we have the wholesale warehouse, the dominoes falling, the fight against inflation, and the personal impacts on mortgages, businesses, and savings.
It's a massive interconnected system.
It really is. The big takeaway here is that the central bank uses this key rate as a tool to balance spending versus saving and inflation versus growth. And while you, the listener, cannot control the conductor,
No one can.
right, but understanding the music helps you decide whether you should get out there and dance, meaning spend and borrow, or sit this one out and save.
Exactly. You have to align your financial choices with the tempo being played.
Which brings us to a final provocative thought to leave you with today. It builds right on this idea of the conductor and the price of money.
Lay it on me.
Depending on the rate, the very nature of money seems to change. When rates are near zero, money is abundant. It's cheap. You want to trade it for assets because holding cash is a losing game.
Right, cash is trash.
But when the key rate is high, money becomes scarce. It's expensive to acquire. And in economics, when something is scarce and yields a high return just by existing, it becomes a luxury good.
It becomes the asset you want to hold.
So here is the question for you to mull over. Look at the key rate in your economy right now. Look at the trend. And ask yourself, in this exact moment, based on the conductor's tempo, is the cash in your bank account trash that you need to trade away, or is it a luxury item that you should be hoarding?
If you misjudge that, you're going to find yourself playing a waltz while the rest of the orchestra is playing heavy metal.
And nobody wants to be that far out of tune. Thanks for joining us for this deep dive. We'll catch you on the next one.
Take care, everyone.